Here we are going to discuss the topic of accounts receivables and bad debts. So this is a situation where a company has granted the customer time to pay their bill instead of having to pay it right up front, and then the customer does not pay. So we have to figure out how to handle the non-collections. So again, the only time we're going to have an accounts receivable situation is if we have a credit sale or a sale on account. This means that the store, the seller, has granted the buyer extra time to pay. We're going to accept the payment over time. Generally, we're saying 30 days, maybe 60 days. Here we have to set up individual accounts for every customer. Now, this is a key thing. In many courses, many textbooks, they start off the discussion just talking about accounts receivables in general, but up front, it's important to know every customer has to have an individual account. Otherwise, we'll never have a way of knowing what that person owes us. We have to track their payments and their remaining debts. In this example, we have a customer, two different customers who have purchased merchandise from this company. So on July 13th, Flexter Company So here we have some examples. On July 13th, Severson sells $950 of merchandise on credit to Flexter, one customer, and $1,000 of merchandise on account to Skylar Incorporated. So the important thing to note here is we have two terms, on credit and on account. So these mean the same thing. It means the seller is granting the customer extra time to pay. Now what we would do there for each situation, we would debit accounts receivable for each individual customer for the amount they owe us. That increases that asset. And we would credit sales for the amount, again, of the sale. So what we have here, if we take a look at the individual situation, we have an accounts receivable, what's known as a subsidiary ledger, for each individual customer. So that shows the transaction for Flexter and then for Skylar. So we debited accounts receivable. We have a balance of $950 and a balance of $1,000 for Skylar. Now, if we take a look at the schedule, a lot of times you'll have a reconciliation or a schedule, a listing of those accounts receivables. So in total, we have $1,950 of accounts receivables. If you look at the general ledger, the control ledger, this is the overall kind of the master account for accounts receivables. It shows $1,950 debit. This is just the sum of all of our subsidiary accounts receivables. So again, we're back to this transaction just like before. We had the debit to the accounts receivable, credit to sales for both customers. Now on July 31st, Skylar Incorporated is going to pay their bill in full. They owed us $1,000. They're going to pay the full $1,000. The normal payment would be a debit to cash, assuming we receive cash, and a credit to accounts receivable to reduce that account. The problem is now Flexter never pays. So we have a bad debt situation. We try to collect from them, and at some point we realize, hey, they're just not going to pay. Maybe they're out of business. Maybe they're bankrupt, whatever the case may be. The problem here is that accounts receivables and bad debts are unfortunately a cost of doing business. In a perfect world, everybody that promised to pay would pay, but that doesn't always happen. So you have those situations where you have to figure out what to do with it. Now, the reason this is important is that since we offered credit sales, chances are we have earned more revenue because of it. We gave customers more flexibility in payment. Therefore, it's more likely they'll come to our store than somebody else. So we have to account for the expense. We can't just assume that that account will eventually be paid. We can't leave it on the accounts receivable forever as an asset if it really has no value. At some point, we have to expense it. So that's what we're doing in this next section here. We are first going to start off with the simple approach known as the direct write-off method. So in this case, on October 13th. So it started on July 13th, and after 90 days or 3 months to October 13th, we realize, hey, we're not going to be able to collect the debt from Flexter. At this point, we're ready to write it off. Again, we cannot leave this on the asset balance as true value if we really don't expect there to be any value. If we don't expect to be able to collect it at some point, it has no value. So what we would do under the direct write-off method is we would debit bad debt expense for $1,000 and credit accounts receivable for that customer for $1,000. So we're doing two things here. We're increasing the expense. Remember, allowing these credit sales generated more revenue, so we want to try to match that up with expense. If we really can't collect the sale, we're not going to reduce revenue. We're just going to increase expense. It'll offset it on the income statement and will reflect the fact that we had an additional cost of doing business. We're crediting accounts receivable to pull it off of that customer's books. We're taking it out of the asset. We don't want that $1,000 asset to be there if we really don't think we're going to be able to collect it. Now, the important thing to note here is that the customer is not off the hook. They still owe the money. So just because we credited accounts receivable for them does not mean that they no longer owe us the money. We're still recording it somewhere. We have collection history somewhere. We're just taking it off of the balance sheet, off of the asset. The direct write-off method is pretty straightforward, but it is not GAAP approved. In other words, any company that is required to follow GAAP, anybody that's a publicly traded company, for example, cannot use the direct write-off method. The reason for that is that it violates the matching principle. Now, what I mean by that, earlier I said that we sell product, we generate revenue, we record it. Now, the matching principle says any expense related to that revenue, we want to match up in that same period so our net income reflects both items at the same time. With this direct write-off method, again, a lot of companies wait 90 days, maybe 120 days before they write an account off. Chances are pretty strong that by that point, you're in another accounting period altogether. Let's just say you have a sale November 1st of 2016, and then you don't write the account off until February or March of 2017, in another year. That's where the violation of the matching principle comes into play. Yes, it is more accurate because we know the exact amount of bad debts. We're not trying to make an estimate. We realize this customer is not paying, so now we know this customer is the bad debt. The only problem with it is it's not timely. We don't get the information in sufficient time. So we have a couple of other methods, or we have really one other method that is allowed, but we're going to see detail. We have sub-methods, if you will. So the allowance methods are what are required by GAAP. What we're saying here is we're setting aside an allowance, an estimate of how much we expect to have in bad debt based on prior year history. That way we can match them up in the same period as the revenues. It's not going to be as accurate because it is just an estimate, but it is more timely, and we're willing to sacrifice a little bit of accuracy to get that timeliness. So in this situation, we're going to have one journal entry when the revenue was recorded, and then another journal entry when we actually write the bad debt off. So the first entry here is going to be a debit to bad debt expense, just like it was before. This is in the period that the revenue was recorded. The credit, however, is not going to go to accounts receivables. The reason is, at this point, we don't know which customer is not going to pay us. We just have an idea as to the estimate of the amount that we aren't going to be able to collect from all customers in total. So we debit bad debt expense to increase it, and we credit the allowance for doubtful accounts, which increases that account. So that's an important thing to note here. We'll see the balance sheet in the next slide. The allowance for doubtful accounts is known as a contra asset account. What this means is that it offsets the asset value, the asset being accounts receivable. So we're going to see, in fact, I'll move forward to the next slide and then we'll jump back. On the balance sheet, you're going to have accounts receivables less the allowance for doubtful accounts. That gives you what's known as the net realizable value of accounts receivables. So allowance, sometimes called a provision for bad debts or allowance for bad debts, this offsets accounts receivables, so it has the opposite normal balance. The allowance for doubtful accounts is a contra asset. It has a normal credit balance, which is the opposite of an asset. We are increasing that allowance in this entry. Now, later on, when we eventually find out that a customer won't pay us, a specific customer, instead of having to debit bad debt expense again, we debit the allowance for doubtful accounts. What we've basically set aside a fund or a cushion account, a provision for these bad debts, so that when we eventually do have a bad debt, now we can use up some of this money. That's the way to visualize what's going on here. So we're debiting the allowance for doubtful accounts to decrease it. We're using it up. And we're crediting the accounts receivable for Smith. That's the customer that didn't pay us. We're crediting their accounts receivable to reduce it. Again, they still owe us the money, but we don't want to record it as an asset anymore. So on the books, if you look at the T accounts here, we would have the accounts receivables with a debit for $1,500, a credit for $300 for the allowance for doubtful accounts. This is in total after everything, after all other transactions are recorded. Now, the allowance method, any allowance method we use, they're based on estimate. We don't know which customer's not going to pay. Therefore, as I said earlier, we can't reduce a specific customer's account until we find out that they aren't going to pay. So we increase that allowance, which offsets the accounts receivables in total. So notice in the last few slides, we didn't have any amounts there. We just had X's. We were just looking at the debits and credits specifically. However, eventually we have to figure out what is the estimated bad debt expense that we're trying to record. There are three methods that we're going to talk about in the next section. I wanted to introduce them here. We have what's known as the percentage of sales method. We have, and then the second one, percentage of accounts receivables method. There are actually two of them. I've broken those into the last two bullet points. We have the one that's based on the actual percentage of the total accounts receivables, and then the aging of accounts receivables method. This actually breaks the accounts receivables into age categories. In other words, how far past due is the account? The further past due it is, the more likely we are not going to be able to collect it. This is just an introduction of the three methods. The next section will take us into more detail about each of these methods.